Alex, welcome to the Market Masters podcast. How's things, dude?
Thanks for having me. I'm doing great, as much as it's possible in winter. How about you?
in the winter. For reference, Alex was in Dubai last week, so he might have some winter blues, right? Mind you, you live in Cyprus anyway, so you got that Mediterranean feel, all year round. But yeah, I'm fantastic. Thank you for asking. As we do with all of our guests on the Market Masters podcast, I'd like you to give a brief introduction as to who you are, why people should listen to you, what's your experience as a trader, and then we'll move into your journey with Darwinex.
Right. So I've been in the trading industry for like close to 20 years now. I literally started as an intern. Like, it was not something that was on my bingo card at the time, to be honest. I had, like anybody who sort of enters the retail trading arena, I had some money. I thought I knew what I was doing. I trusted the wrong people and information, and I lost it all. I took a loan of my parents and lost that on top. That was back then. It was their retirement fund, actually, that they cashed out for me. And so let's just say I had to jump through a couple of hoops. Over time, what happened is that I started as an intern at an investment bank because I was not willing to go down like this, basically, and learned from my experience there, bit by bit, over the course of years, actually, both sides of the trading arena, like the provider side, the brokerage side, the risk management side, the bank side, the liquidity side, but then much more, and that was the part I was more interested in, the asset management side, simply because my dream and wish was at the time to generate return with my own capital, and then actually to be in a capacity to do that for others as well, instead of being a provider where you're basically a platform provider providing liquidity or a possibility for people to trade, let's just say. And as you and I both know, a lot of times that puts you in a bit of a conflict of interest, tricky situation with your customers to some degree. No, hard feelings or bad mouthing about that. It's just like the nature of that beast, let's just say. But I wanted to be a value creation, or on the value creation side for the actual customer. And over the years, I worked my way up from the intern, making coffee and just trying to get some information left and right from even in the bank, very few customers that were successful. And then starting to develop my own strategy, ideas, eventually pivoting over into the hedge fund space. Ran the trading for Swiss Hedge Fund in 2012 and 13, actually won 2 investment awards at the time in London and New York. And ever since, actually have gone trading on my own, friends and family. And I recently started to, basically bring myself back from semi-retirement. And this is why I created my Darwin. We are now 3 years strong of a track record on the platform, and we are in the very process of building an asset management business or scaling an asset management business around that. That's like the very quick one from here.
Are you looking to, so you're saying you're looking to get back into asset management. Are you looking to create your own fund or kind of work with other funds that are already created as a trader?
Yes. Look, I've had experiences in the past, and setting up a structure that can accept client money and fulfill all the regulations, the reporting requirements, the audits, this and that, that is not for the faint-hearted and takes a whole lot of capital, obviously. So doing that and it can also distract you from what you really need to be doing, which is create trading results, right? And if you're distracted on that end, anything else that you may spend 6 figures on annually and more is worthless in a way. So at the moment, I'm not focusing on losing myself into that, even though, and Darwinex is a perfect solution for that. Let's just say we're part of the index. We also had like, I think, over 120 investors over time, 7 figures. So that's really a great way to get into it. That said, I'm dealing now also with some family offices, institutional investors, and they usually have their own custody and requirements for how they want their money to be managed or need their money to be managed. So, and still I'm not running like my own fund where they send me their money, but they're giving me access to their own, let's just say, setup so that we can replicate our trading strategy there as well. So it's basically twofold at the moment. And just maybe as a quick tidbit here from the beginning. So what we do is like we run a risk-governed FX strategy. So my edge is not prediction, because a lot of times people think like you need to predict the market, but in our case, it's structural execution and most importantly, drawdown governance. So that's how the capital stays intact across any market phases and regimes. So that's just that we can dive into that a little bit more as we go along, but just as a quick explanation of what we do.
Yeah, I'd like to go into that a little bit more now, if possible, because I think it's an interesting topic, right? Is you have traded both as a retail trader and kind of on the institutional side. And I'd like to hear, is the way that you trade now, the way that your strategy is set up, you're saying you're not predicting the next move, right? Which I think is what a lot of, especially newer traders, are trying to do on, on a day-to-day basis, is looking at the euro dollar and thinking, well, I think the euro dollar is going to go up and therefore I'm going to place my chips on a long trade, for example. Is this something that you've learned over years working in the institutional arena? Is it a different way of trading to what is, showcased on YouTube for the average retail guy?
Yes, I think what you learn, especially in the institutional space, is that to trade profitably, you need an edge. An edge means you have to have some sort of an advantage on your side, and an edge that needs to be measurable, quantifiable, replicatable. You need to be able to do it and do it over again. Like I've seen, I'm sure you too, tons of strategies that look great on paper, but when it comes time to execute them, they fail on liquidity constraints, like they're just like fantasy strategies that don't work in the real world when they really suddenly have to face bigger execution tickets and things of that nature. Plus, also, people believe to have some sort of a strategy and an edge when they have only been in a simple market phase or regime, and then once the market changes, they end up losing, and they often enough give back more than they actually made. So what I would like to say is or start by what my strategy is not. Like you said yourself, it's not predictive. So it's not indicator driven. And that's certainly something where I found my edge. So yes, it is true that anything can work in the market per se, but that's also a very wide way of saying things. So it's like more of a cliche talk. Yeah. And while it's true, you have to find out what is true for you, what works for you, what can you actually continue to deliver time and time and time and time again across multiple years. This is why, for example, our Darwinex track record is 3 years now. Anything under 3 years can still be luck, can still be, it's not necessarily a method that you can replicate. So also, and that's where I would like to differentiate of what we do. We do not rely on timing or lack of a certain market phase, also not on taking big leverages on the move that worked out sort of thing. So what we do is a probabilistic execution framework. And we choose liquid FX markets simply because we have low execution costs. We have within our structural approach, you have price acceptance and rejection. In simple words, it's support and resistance, trading from zone to zone, and looking at higher time frames, scaling down to the lower time frame. And as much as I'm sure people would say, well, anybody knows that, but really doing that and keep doing that, this is where things are different to the other. And the biggest, most important aspect to that, and this is basically our trading desk culture, is capital preservation as the primary constraint. So my edge, or our edge, is not the entry. Of course, we have parameters of when we choose to enter the market. We're not just going into the market randomly, but the edge is not the entry per se, because I look at trades and sequences. For example, like one trade for me can be up to 5 different entries if I have to. But not more than that also. Like, I'm not martingaling myself into something forever and hoping it will somehow play out. And that's why, like, our edge is actually consistency under pressure. And we have a very strict drawdown playbook. So everything is defined, like, as to, once I have my first trade in, where would I put my second trade, my third trade, my fourth trade? How do I react if the market continues to go adversely to what I expected, and things of that nature? So everything is completely defined before we deploy any capital. And that's very important. I think this is actually the biggest difference between institutional trading and retail trading, is that as an institutional trader, or someone who has a responsibility of capital stewardship, you need to have a complete playbook. You need to have a completely formulated approach as to what you are going to do, also across certain different outcomes that may happen. And you have to look at it a bit like a chess player, as to, you cannot just look 1 move, 2 moves, 3 moves. You really have to have more than that to know what you're going to do when it happens. So in that sense, I consider myself a lot more a risk governor and not an opportunity hunter. Because markets, they give you opportunities. There's endless opportunities in the markets. And I think also this is one of the differentiation between retail. Retail always thinks, this is it. This is the one opportunity. If I miss the boat here now, I will never be able. Such like, look at the Bitcoin price right now, 74 grand. And people thought like they missed the boat and bought at 124, and so it's important that you understand that no opportunity is a missed opportunity, because there's always new opportunities. And another thing where I would really like to differentiate between, even in the institutional space, is that drawdowns are something people don't like to talk about, are something people don't like to define, other than that, like, okay, our drawdown max is 10%, 8%, whatever it is. That's sort of the beginning and the end of the conversation about drawdowns, right? That you hear from people. And then, oops, yeah, we hit our limits, cut off. That's it, right? If you're lucky. If you're not lucky, it's like, oh, martingale, damn, gold went up, or we dropped 20% a day, sort of thing. No, but to bring it back, to be serious here, drawdowns, in my understanding, and this is what I learned in the institutional space, but also in 20 years in the market, there are, to me, it's an operating state. It's not a failure of a strategy. And it's actually very important that you understand that drawdowns are part of what you are going to do. And if you look at drawdowns as an operating state, meaning it will happen. It's just like when you drive a car, sometimes you accelerate, sometimes you hit the brakes, right? And both sides need to work in a reliable fashion. So you need to understand your drawdowns and how you operate your drawdowns. And then you can, it's just business as usual, because your risk is defined before you enter. Again, we are risk governors, not opportunity hunters. And so what I look at when I said sequence, for example, is that I do have a different, a specific range that I'm targeting within my trading sequence, okay? This is why FX is great also, because in my opinion, in FX, you have two forces pulling and pushing against each other, a lot more than in stocks or in crypto, where you have a lot more stronger and longer going trends, because it's typically a stock price versus the US dollar, right? It's not Canadian dollar and New Zealand dollar, for example, or something like that. So you have more of a push and pull in currencies, which means like for that to stay within a certain range, the probability is higher. Not to be confused though with a guarantee that it will happen like that, but because this is how people blow up, right? Because they over risk and they keep adding to losers. So also very important, what we don't do is we do not do martingale. I think martingale is especially in the retail space. In the retail space, martingale is like the go-to. You know, when people are probably the first most people have ever been consistently profitable is hitting a martingale type of strategy in a market that did not overextend. And then when it overextends, and people are surprised like how hurtful it is and how it can literally destroy the work of far too long time and effort overnight, just like that. So that's why it's important. We have no martingale. We have no recovery behavior, you know, like, oh, I need to add, I need to get this back or whatever. So we have our distance based on specific sizing from structural invalidation levels. Not vibes, not fixed lots, not doubling lots, not any of that really. Yeah, you know, I mean, especially in this social media driven world that we live in, or call it sentiment, you know, like sentiment is obviously something that it plays into it. And this is another reason why I have found my niche in this FX space, is because it's for my approach, it has less of that noise going on, okay? And that allows me to really also be a lot more non-correlated to the regular market, to sentiments, to any of these things, which I think is another important aspect, particularly if you're looking to raise capital over time, is that if you're making money when everybody's making money, then what's so special about you, okay? But if you manage to make money even when the market is down or throughout many years consistently, then it becomes more interesting. And because just from a diversification or from an allocator standpoint, you are infinitely more interesting now for that just simple one thing, right? And another thing that I think is very important is scalability. And I think also what a lot of people misunderstand about scalability is that they crank up their lots. They don't scale linearly. Let's just put it this way. You know, they just try to increase the risk on what they do, and then they're surprised about like how much of a painful other side there is to that, and also when they suddenly run into execution issues, you know, slippages, all of these things. And so for me, it's also important to understand that I'm in a market that really gives me the ability to execute size and also in a shape or form that allows me to scale in a linear fashion. So yeah, that's sort of it. So if I had to think about like how would I, because I'm really, what I would like to do in this conversation is to express myself in a most simple way as to what we do in trading, because I really think that trading is a bit mystified, or it's a bit too, either people make it sound like you need like a rocket science degree for it, or people think it's just like YOLO, right? And I think the reality is really quite boring. So what we do is we trade structure, market structure, based on mean reversions, but also with a conditional continuation, depending on like the top-down approach that we look at. So I start by identifying higher time frames where price has been accepted or rejected the value. And you can easily see that, you know, I have it on my YouTube, by the way, like I explain my strategy there as well. If you go on the higher time frame and you have certain zones where price reacted multiple times, then you draw a line there. You don't need 100 million lines really to understand where price has been accepted or rejected. And then I go into smaller time frames and I look, you know, where we had on the smaller time frames also invalidations. And so what we look is that we also, and this is very important actually, we enforce a minimum asymmetry. So which means is that there needs to be a specific risk reward in place for every trade that we attempting to take. Otherwise, we will simply not take it. Even if it looks like a no-brainer trade, if the asymmetry, meaning I look at 2-to-1 minimum. If I don't have a 2-to-1, I don't take the trade. It's not worth it. And all that, by the way, and this is where we get back to the institutional side, I derived over many years of seeing how institutional works, which is with data. Analysis, data, and you don't need to be like a crazy AI quant mathematician, super brain for this kind of trading. Of course, there's certain strategies where you need to go more into the smaller bits and pieces. But that's really it, like we trade inside bounded sequences with predefined limits. We supervise the execution. We increase the sequence only, or the complexity of a sequence, meaning like how many trades I add, depends on how far the market runs. But the rules that we engage in as to when and where we put a trade, where it's invalidated, they never change. Absolutely never. That's really, really important. And which makes this kind of approach a bit boring, particularly maybe for the retail person. But once you get to a point where you're managing 8, 9, 10 figures of capital, it's not boring to be reliable. And yeah, but I just thought already, so chime in here.
No, I wanted to ask you because I think it's super interesting. Your alpha cap is quite large, specifically for because you only trade one asset, right? Am I right about that, or do you trade multiple assets?
We trade like a few currencies, but depending also on which one looks the most suitable for our rules, basically. So at the moment, I'm very much centered around Australian dollar, Canadian dollar, and New Zealand dollar and Canadian dollar. So that's at the moment literally my 99% of trades. Yes.
Okay, so are we talking purely majors, or are we talking yen crosses and exotics as well? As in, would you just trade New Zealand CAD, or would it primarily be New Zealand dollar and Canadian dollar, etc.?
I would like the majors. I find better opportunities in like New Zealand CAD, for example, than in a New Zealand dollar. And again, I think it has to do with the push-pull relationship of these two smaller currencies, particularly in comparison to like a big US dollar currency that has a lot more cross currents happening to the reason of why it's moving.
Okay, the reason I ask that, which actually makes it more interesting, and I'm keen to hear your thoughts. Your capacity is super, super high. I think we're talking 230 plus million. In terms of, for anybody who's listening who doesn't understand what I'm talking about, is the alpha cap, or the amount of capital that Alex's strategy can manage before it starts to incur slippages and poor fills and just basically poor execution, meaning that an investor wouldn't get the same return as Alex may do as a trader trading it on a smaller account. Now, your capacity, like I say, I think I've got it up here. Let me just double check it. I think as of right now, updates once per Monday. As of right now, we're looking about 228 million, which is large for somebody, especially if you're trading, the cross pairs and not major pairs 100% of the time. So I'm curious, I know you said you will work an area, you may enter up to 5 times. Was there any logic baked into your sequence or how you approach each individual position to increase the capacity? Or is that just like an inadvertent side effect of how you trade?
The capacity is probably like, it's not that I woke up this morning and said like I will only choose these pairs because I want to trade 250 million AUM or volume on that. But I think it's the natural consequence of the approach that we're following, because again, the type of patterns that we trade, they and the market that we're in, we're still talking about like big economies with like huge amount of currencies, right? So and I'm sure you could pair trade if you want some sort of stocks in a similar type of strategy. But again, you would have a lot more noise happening in there. And so I think that in particular, the strategy or choosing this asset because it fits the strategy best, then consequently leads to the available liquidity for it as well.
Yeah, it's a super interesting point because, as you can imagine, I talk to hundreds of traders every single week. And one of the biggest issues that I have with these traders when I'm talking to them and giving them a review of their Darwin or their strategy is it's not scalable at all. And it's quite a harsh topic to cover with them. You know, I might have somebody on a call who's really enthusiastic and they're really happy to be there and they're super eager to learn. And then I tell them they can only manage 500K. And, you know, it's unlikely you'll make a career out of that. And you can see their face drop. So I always find it fascinating when somebody, especially when they've given it very little thought, has a high capacity. But there's things that you do, right? If you're working an area, it allows you to cover your size without just clipping it all in one go. Of course, for somebody who, for a larger investor who is allocating capital to you, it's beneficial for them because they're going to experience like smaller amounts of slippage, at least on each individual trade. So it was just something I wanted to pick your brains about. Although I thought that would be your answer, is it's kind of an inadvertent consequence of just trading the highly liquid strategy, which is super interesting.
To add to that, is that also the way you trade it, I think you said it just yourself, is that if your average profit is in comparison to the spread per trade that you execute is not in the right space, then it will be very difficult to scale any strategy for that matter, where it's like that, because the costs are eating you. And any small amount of slippage is going to significantly cut into your profitability and ability to scale and execute. And if you do that, even worse, for example, in a less liquid market, then there's no chance of really going anywhere with that. So that's why it's important to consider these things. Like, but for example, on our track record, you can see like in 2023 and 2024, especially in the beginning of 24, but since then not anymore, the risk per trade was trading more aggressively. What happened there? What happened is that when we started trading that, we approached it more from a standard FX type of trading strategy, okay? But as we transitioned towards a more family office and institutional capital type of approach, we deliberately moved to a lower, more professional risk profile. So we had materially lower drawdowns since then, but we preserved the underlying edge. So that's also the thing. You have to be willing to not, get ahead of yourself. I think this is very important, especially if you're looking for growth. Risk-adjusted quality improves. That's what happened ever since then. So, for example, last year we did, if you look at it, potentially the lowest annual return, but we had the very, very, very lowest drawdown ever on an annual scale as well. This year has started off with a drawdown, for example, and that's just not, other people would be unhappy or worried or any of these things. But again, this is what I said earlier. Like, drawdowns to me are an operating state, and many investors look at monthly performances as realized, so mark to market basically. What happens with us, especially with the sequences and the invalidation levels, is that many times, and you can see that also in our history, is that the drawdowns are typically having much bigger returns right after, right? So they're reflecting positions mid-cycle rather than a realized loss, and that's not a loophole or anything fancy here. It's just an accurate way of displaying what we're doing. So we don't try to curve fit ourselves into a month, into a year, into any of these time units. Our drawdown and our drawdown governance is predefined. So we start every single trade we trade typically is very small, and the sequences that we add to these trades, they are capped. We have a clear like maximum increased sizing that we can add in total and a maximum risk per this trade in combination of the whole thing. And the edge, the underlying edge of where and when we enter, even each of these sequences, trades in the sequence, is the same edge, you know, and that's why I believe we can really scale this in a very reliable and big fashion, also because it's shown to do exactly what it's supposed to do for 3 years now, which is the beginning of a real track record, in my opinion, as well. And it's I understand that people that want to make a career from trading, the one thing they don't have is time, or they think they don't have is time. In reality, I think, however, it's impossible to grow into a trading career without time. That's what I believe for sure, especially after being 20 years in this.
Well, time equals experience, right? Is when you're looking at just market conditions or understanding how a specific asset trades, whatever it may be, time will always give you experience. And many people try and run before they can walk, and you know, of course, run into issues further down the line. So I completely agree. You know, people should take their time and not rush certain things, because there's lesson in every trade, in every week, in every month, in every year. I'm curious with so when you say that you're now curating your strategy for family offices and, you know, larger amounts of AUM, how does that kind of influence what you do on a day-to-day basis in terms of like when you're executing?
Mm.
If you can share, I'm like, I don't mind if this is protected IP. We can skip that question.
Honestly, even if I sat down here and explained every little detail of what I'm doing, for someone to go out and do it it's not the same thing. You know, information alone is not the differentiator. We live in a time where information is plentiful. The execution of the information and really the stripping away of the noise and your personal urges and all of these things is a lot more important. And this is actually the answer to that question. We enforce discipline. We do not improvise. There's a tail risk protocol. So protocols keep us alive. And we will also at some point, if necessary, start to hedge certain extent. And even then, I've seen a lot of people trying to hedge some of their exposure and then never get out of the hedge again, and then ending up on losses on both sides. And
fees, hold, yeah.
And that's why it's triggered on the specific criteria. That criteria has been developed and quantitatively put together over many years, and protocol again. We have a weekly protocol. We review our trades of the week and we make an outlook for the upcoming week's trades. So, and we also consider, what did we do good? What could we have done better? What did we not do good? You know, and as you bring a boring way of doing that over and over and over and over again, you're just focused on your task, and you really get away from the shiny objects, from the distractions. And that's also interesting because we talked about earlier. So I did win this award in 2013 as best macro manager, but I like macro news or fundamental news. They are not part of my strategy today. Zero. And actually, by having this methodology, like this method that is based on numbers, I don't mind. I don't care really. You know, like it goes up, it goes down. For this reason, for that reason, this is what I also learned about the years. If you remove yourself from that stage, you increase your capacity to focus on your clean execution and following of the rules and reviewing of what you've done, and improving that, instead of being pushed away left and right for, like, Trump said this, and so on, so and so forth. And of course, the time we're in right now, it's never been as shaky and reactive ever before. But I think particularly that is important for you to not get into this whole social media feud, but to understand, okay, what are my ranges? What is the volatility profile? What, like you adjust to these numbers. You adjust to actual data of the market behavior and not what you consider to be the cause. The causes could be anything, and we will never really know, right?
Mm-hmm. So you hit on some interesting things there. I mean, as you do in every point, you always raise like 4 different ideas in my head that I want to ask you about, and then by the time we get to the end, I'm like, oh my god, what did he say earlier on? But there was something that I wanted to ask you about in regards to the family offices, and it's something that I was talking to somebody about this morning actually, and trying to change their opinion of that. They're basically looking, let's say, at the end of this year, what my equity curve should look like, and they're like, that's just not enough. This just isn't enough. This, yeah, and so many different things. And all I say is robustness and consistency over everything. Like I would rather have a stable curve with lower drawdowns, as you've been talking about, potentially giving up a small amount of percentage yield per year for a more stable curve. Is that something that when you're pitching to, or when you're talking to a larger allocator, is that something that goes through your mind? Is that it's kind of a differentiator for you? We know that the S&P, for example, or many benchmarks, they're fairly stable until they're not. And then you might have a down period for 2 or 3 years. And it's like, well, it was stable for the last 10. Now we've had a 15% drawdown. Is that kind of, do you see that as a differentiation for yourself? Because up until like current date, DOQ is one of the more stable curves I think I've ever seen.
Mm-hmm. And I think that's, or what I decided is the one thing that matters the most, whether my process survives boredom, but also volatility, but also drawdowns without changing its character. So, and even we have this drawdown now, which is still, in comparison, it's contained. It's like not a nothing out of the ordinary per se. So the objective is not to eliminate drawdowns. The objective is to ensure that these drawdowns are finite, they're governed, and they're non-destructive to the long-term expectancy. And that's really would be my answer to that. So as long as we make sure that we survive the market phases, both of them, the boring ones and the volatile ones, and the drawdowns, without changing the character of our approach, then that's what we do. That's what we worry about. I don't worry about the actual number at the end of the year. I don't worry about curve fitting. I don't worry about dressing up for whatever kind of investor. I'm running my thing following these principles, and whoever resonates with that finds its way to work with us.
Fantastic answer. I couldn't have said that better myself. I wanted to ask you about your experience as kind of a professional asset manager, and why you kind of, I know you and I have spoken about this in the past, but I'd like you to explain your thought process of actually stepping away from that. I know at the start of this interview, you said that you come out of semi-retirement. What were the reasons that you stepped away from kind of the institutional side of things? And now, as you've decided to come back, instead of going back down that avenue, you're actually coming as a retail trader.
I would really say the most simplest reason for that was living my life. When I left, like, look, I won these awards, and we were really doing quite well. And then I had my first son and bought my first house and these kind of things. Then I asked myself, okay, what do I really want from life? Do I want to climb up the, career ladder, and or do I want to spend time with this newborn in an irreplaceable fashion, which cannot happen like that again? So that's why I stepped down from pursuing the career path aggressively, but also because I had a skill set that ensured I could support myself, and had still friends and family around me that gave us enough AUM to, let's just say, have a decent life. And then as the years went by, and I went through different phases in my life, kids got older, and it's also, I think a lot has to do, especially since COVID, like markets have become like a magnet for almost everybody, you know? When I started in my career, like, and you would go to Christmas dinners or things like that, nobody in your family would ever talk about markets or trading or anything. And today it's like, you know, and then this whole phenomenon of Instagram traders that look like rappers, bad rappers, maybe even. It's like that sort of intrigued me. It's like, okay, we have two things are happening here. One is that a good thing is that a bigger part of the world, of the youth, is actually interested in markets. And another bad thing was happening is that all of that interest had been exploited by stupidity of a retail offer, for lack of a better word, very respectfully stated. And as I saw my kids grow up, I said, like, you know what? I want to play a role in that game, but reflecting my values and my ideals. And this is why and how I got back into it. And instead of saying like, look at me, I'm this Lambo guy, buy my course sort of thing, so like, let's start the other way around. Let's build the track record first, and then surface on social media, podcasts like this here, and stuff like that. Because, and it's funny because 4 or 5 years ago, people could go on social media and say all sorts of things, and they would easily gain thousands of followers, and they would move them all offshore, you know, churn the heck out of them, collect the P&L, and all of these things. We know the games, right? But now we're a little bit post that stage, that especially in the highly regulated countries, people they know the scheme behind it, you know, and it's not as easy to do it anymore at all, actually. And that's a perfect opportunity. Again, I think time works in your favor if you're actually playing the time game, and not if you don't rush things, if you stay true to your ideals and to your look. You have to decide what you stand for and what are your principles, and then you also have to be courageous enough to execute it despite your urges. And the best way to do that is that when you're not financially reliant on what you do there, right? And when you have the mindset of that, it will exponentially grow on the tail end. And this is, I firmly believe that. And I'm actually, I would say, in the beginning stages of experiencing that. A lot of the other traders' mindsets is they crash and burn and churn infinitely, again and again and again and again and again. And that doesn't get you anywhere. It depletes you. And that's sad. So this is the reason why I reactivated myself. I said, like, okay, I want to be a role model to my children, actually, and show them how we can do this actually correctly, long-term, and really reliably.
Which in this day and age, there's not enough of that, because it's funny you mentioned the churn and burn, which I'm presuming that you mean, sending traders or sending clients to an offshore broker, sending them signals, blowing up the account and getting paid the CPA commission anyway. I kind of feel like that.
Oh, P&L, right? Even worse.
Yeah. And I think that has, for the most part, gone, or at least mostly been eradicated. And then what we've seen in the past few years is actually more personal stuff, where there'll be a trader who gamifies a prop firm or a funding challenge. They'll show a payout and then they'll say, buy my course. And it'll be some 21-year-old kid, who actually has no idea how to trade and build a record, but has found a way to gamify prop firms. And then they will make so much money from course sales and education stuff. So my question to you is, how important do you think it should be for a trader to have a track record like you do before selling some form of mentorship or education? Because otherwise it's just words, right?
Yeah, absolutely. You said it yourself. I don't have much to add to that. Like, if you don't have a track record, then what do you have to teach in the first place? Look, again, there are people that got really, really lucky being in the right place at the right time, taking big risks. So I'm not saying that what I do is the only way to make it to something. Absolutely not. But what I can say is that in a long-term perspective, I believe it's the only way that you can build into and grow, actually. Because if you've bought Bitcoin 10 years ago, congratulations, or you made money on some meme coin or any of these things. But a lot of times these people, they have short-term gains that really was like it was opportunistic. It was not structural. And so what I choose for myself is more of being more on the structural side. Of course, I have my opportunistic plays that I do for myself, for my own money here and there. But even that, I have kept to an absolute minimum. I think everyone who's gone through the crypto circus at some point realizes I'll just buy and stack Bitcoin and forget about the rest. And or sort of something comparable to that. So maybe it's my age also. I'm turning 45 this year, so I guess it has something to do with that. I still consider myself pretty young, so I'm at least looking at another 100 years of trading, hopefully. But all these things come together, and I also, the lifestyle I built around that is, I care about my health. I care about going to the gym. I care about seeing the sun, getting steps in, eating well. It's like if you're making money, but you're sitting in a dark room, you're eating bad, you're not treating yourself well, then just because you jump in your Lamborghini to drive to McDonald's, that's like a good life? I don't think it is. Look, again, everybody needs to make choices for themselves, what they deem to be good or not good. But especially as a father and someone that aspires to be a role model, I'm definitely not saying I am or anything like that. I think remaining humble and focused on the process is the number one important factor to never forget about, because success is rented. We all know that. And the rent is due every single day, just to use some social media talk here in between as well, sprinkled. And so I believe if you manage
that quote, success is rented, is due.
I'm sure you've heard that before.
Don't worry. I will, if I post that, I will definitely quote you on that, because that's a fantastic quote to stay grounded.
And I think also what you can see on our track record on Darwinex is that really the point for me is not the headline return, something that you said. It's the stability of behavior through different market phases and regimes. That's really the one thing I would like more and more investors or people interested in trading really stand out to them. That's what I care about most. And the way we did that is also we built a whole desk culture, a trading desk culture around this one idea, which is that markets are uncontrollable in my eyes, completely. What is controllable is behavior. And that's actually even on a personal level. I cannot choose what life is going to do to me. I can choose how I react to it. And that's why process is sacred. So I don't trade to feel any specific way, to feel right, to feel cool, feel validated, any of these things. I trade to stay intact, to, especially for the capital that has been entrusted with. So, so you have a responsibility, a stewardship. And so we treat every, and if you deviate from that, that's a risk you want to avoid, that you want to also be conscious about. And that only works when you have your culture, like something that you really live by. So, and I actually think most strategies don't fail because the market is hot. They fail because humans change the rules under stress.
Mm-hmm. Well, stress is one of the, what's the quote? There's a quote on it, and it's talking about how stress is one of the main principles of Oh, I'm gonna butcher it. Maybe I'll have to send it you. Take a look after the interview and
Or
send it across. But basically, in essence, is like uh, what you said hit the nail on the head. Is kind of like most strategies don't fail because of the system or because of the market. Generally, it's because of the emotional tact of the trader, and the
yeah,
leading cause of like an emotional spike is stress or pressure, whether it's from family, markets, what have you, and the ability to stay clear in that moment and still execute on that process. I think it's easy if you have certain things written down, you know, whether it's rules, whether it's in your head, whether it's a business plan, it's easier to stick to that because you kind of see the bigger picture. Whereas if you just go, you know, gold is going to go up today, so I'm going to buy. That's like, it's a theory, but doesn't, it's not a process.
100%. Rules govern structure. And in my case, it's very clear. I have an invalidation price-wise where the price goes, clear sizing, sequencing, and exits. I have some discretion on my exits only, but only after if I got into a certain number of sequences. Like, for example, if I had to add, like 95% of the trades never reach more than 2 trades in a sequence, okay? And then when you get to a higher number of sequences, then the execution or the supervision of the execution is not changing the rules, absolutely not. That's extremely important. And that's why also what we do is not a fit for investors who's looking for aggressive short-term alpha, and that would be more opportunistic. Discretionary heroism, you know, like there's people that are really good in that. I'm not one of them. Yeah, yeah.
Yeah,
And so and also it's important for me, like you cannot, like in my world, you cannot be a manager that will change the rules to avoid temporary discomfort. If you do that, then you're destined to lose. And what you also said is like you need to write things down, in my opinion. Even more than that, you need to write it down and then keep repeating these things to yourself to understand, where is this still weak? Where's this still not right because I'm not able to do it, or I forget about it, or I want to avoid it, or like, because it should feel like your nature. And this is why I say, like, funny enough, I used to teach trading a few years back, and I did not sell the magic bullet trading strategy. I taught people how to create their own trading strategy. So a strategy that fits them, their character, their approach, they understand themselves so much better over time. How patient are you? How much can you handle risk? What time zone you live in? What markets interest you? You know, like all of these things, if they are not aligned with who you are, you will have a very hard time of putting it into action. It's the same thing as your diet. It's the same thing as your exercise regime. You find something that just works with you, and you have within that, you have certain degrees of variation depending on the seasons, for lack of a better word. But that's it. So, and that's why I know, like, my edge is absolutely not predicting the market. It's a repeatable execution of an asymmetric risk around structure of the market. That's it. With strict sizing and strict exit discipline. That's it. That's literally it. That's all we do.
It's so interesting to hear, like, because I talk to a wide range of traders, guys with experience like yourselves, guys on the newer end, and it's always refreshing to hear somebody so eloquently explain kind of trading in a different way, as opposed to, I mean, I guess we're kind of beating a dead tree here because you've already explained it enough. Is like, you're not predicting the next move. It's just a structure, and that structure is kind of what it is. You take a position, you run the position, you manage it. There's no kind of emotion there. It's all system. Would you say it's systematic, even though you have an element of discretion to it, if it's all rules based?
Yes. So again, definitely, it is systematic, because again, the rules govern the structure. So I only have some elements of discretion within that, but also what I mentioned earlier, only after we had an escalation of sequences. So for 95% of the time, it's completely systematic. And I think this is also what keeps you or your capacity available for when you really need to focus and zoom in. You're there, you can, and you trust your ability and your rules, your structures, and you also you're, of course, like, history is not a proof or guarantee for the future, but to yourself, you've managed through all sorts of market regimes. Then and the more often you do that, especially if over the years you even manage to do it with better or with lower drawdowns versus the results that you're producing, you don't waste your time with being distracted with insecurity or stunts or quick fixes. A lot of times people have issues with their drawdowns because, again, they don't have a drawdown principle. Like, what do you do when you're in drawdown exactly? What is your exact protocol? Do you have one? What is it based on? Do you follow it? What's the history of that protocol? Do you question it? Do you analyze it? You know what I mean? This is where the real work happens. The real work actually happens not on the battlefield per se. Of course, when the moment of necessity strikes, you need to be able to do that. But you can only be, like, preparation is basically winning the fight before you ever have it.
And do you think that's 90% of the battle and execution is just a tiny percentage of?
No, tiny sounds not fair, but the smaller part, yes.
Yeah, because it's kind of like, I mean, I suppose execution, you're doing your technical analysis, you're doing your fundamental analysis, you're understanding where the market's priced, where you believe it's going to be, and then you're placing a position right. That, when I say tiny, I mean it's such a low input task, especially if you've done the majority of the work, figuring out your sequences. If ABC happens, then I go away and do XYZ, and then mapping out, well, if we go into drawdown, this is what we do. Oh, but this is a different type of drawdown, so if this happens, we also do this. And I guess that's where a little bit of the discretion comes into it as well. I mean, I could talk about strategy all day long, but I'm curious to hear. We've had a conversation in the past, and if I remember right, you called, and don't misquote me on this because I'm trying to think back from memory. I think you called the FX market a disease, or you called legacy markets, or the fiat system. You called the fiat system a disease when we was talking about crypto. So I'm curious to hear your opinion these days, because that conversation was a long time ago. And I think the speed of how technology and artificial intelligence is growing, I feel like we will have a completely different conversation now as to what we did 6 months ago. What's your thoughts on AI and crypto when it comes to trading and investing?
So I think very now, AI is still an assistant. It's like it can help you work through data. It can help you sort things. It can help you with machine learning of specific patterns, understand the statistics of certain things better. But I think what it doesn't do yet is really replace the execution side of things. That said, I do think that at the speed it is improving and growing, there is a good chance that it will actually become better in these arenas as well. But I think for the foreseeable future, like for the next several years, I think before AI is going to take over everything, people that know to use AI as their assistant are going to be the winners of this whole transition. So, and also, I think, again, a lot of things that happened why is the fiat system a disease? Because it's an ever expanding debt Ponzi. That's just the reality of the numbers, okay? Governments overspend and they push that money in all sorts of different arenas, whether it's in the economy or in their apparatus or any of these things. And what it creates is like these clusters of inefficiencies. Because the money's coming anyway, and like there's probably tons of jobs today that exist that don't necessarily bring a lot of value, that don't necessarily solve a lot of problems. They just exist from a managerial development of humor, if you want. And so what I think AI will do is clean that, flush that out to a big degree. So yes, a lot of people are looking at massive changes. You know, I've just had a friend of mine. It's not a particularly positive story, but I still will tell it. Like he got fired after like 7 or 8 years working in the same company, and he said to me, it was a comfortable job. I was very comfortable with what I was doing, and so in a way, he sort of said by himself as to why they replaced him at some point, because there was no incentive for him to grow out of his comfort anymore, in a way that he wasn't even looking at potentially how much value he was bringing to the table or not, and how efficient actually his position was versus what he was costing, and any of these things. And by all means, I don't think it's fair that they sacked him. So, but that's another reality of that we live in. Like fairness is a tricky concept, especially if you come from a place of entitlement, right? So the best way to ensure that you will stay ahead of the curve is to be a man of value, or a woman of value, for like, don't get me wrong here. And so it's important that if you don't have that aspiration in yourself, and you're just like managing your time doing nothing in a way, or something far too simple for really to be valuable, then AI is coming for you. I forgot who it was. Was either a big hedge fund manager or big bank manager, something like I said, like, it's a good time to be a plumber again. And I think that's very true.
That's so true. That's so true. I mean, I don't know if you've seen some of the recent video, like the jump in like cinematography and gaming and music. I mean, there's a few AI artists that I listen to pretty much week in, week out. And it's so scary, because when I think about it, I mean, the only thing that you would miss in that respect is obviously, you know, going and seeing that artist live. You know, that's something that you cannot replace, is seeing an artist on stage. Yet, anyway. But when I'm listening to the music, every note is pitch perfect. The words are perfect. Like everything is perfect because there's no human error. And it's kind of unfair, because it's like, how do you compete with that? And then when you're looking at movies, how much do movies cost? Millions, hundreds of millions of pounds or dollars.
But especially with the music, what I would like, sorry to cut you off here, but what blows me away is that you also have like these AI type of music where they take existing songs and create them very different new style. You know, you take a rap song and you make it a country song or something like that.
Yeah.
And or a gospel song, or and those songs, they are blowing my mind. Like I heard, like, for example, Careless Whisper from George Michael in a trap version. It's like, man, that's like people will say like, oh, man, this is Chris Brown or whatever, you know what I mean? Like it's incredible. And this is the interesting part. Still to date, though, the people that create these songs, there's still people doing that. So they take the original song, even or even Michael Jackson. There's tons of Michael Jackson's AI new style. So, and you can hear that the backbone strength of that is still the creative output of a human being in the beginning, but also of another human being repurposing it. And this is actually the perfect example of where I see AI being. Of how AI is going to enrich and actually create new jobs for an economy that we don't understand just yet. If you are that kind of person who can use these incredible tools to create something that you needed a whole studio for, to spend millions, hundreds of millions, that you can do now with computing power, then I mean, I'm very amazed for that future personally. I think it's anyway. I mean, it's happening whether you like it or not.
Absolutely, it's already well underway, and I think I completely agree. I've said the same thing for the past couple of years now. Is I think yes, there will be a lot of jobs that are potentially lost or become redundant. I mean, we're already seeing it now. There's AI support agents that will pick up the phone and talk to you on the phone. So there is going to be a lot of roles that are redundant. However, for every role that becomes redundant, there's probably going to be a new role that isn't yet, like I would say the role now, and you'd be like, what on earth is that? Whether it's like an AI engineer or a safety, whatever it may be, there's going to be so many roles that come about with this new AI economy. I truly believe that too. One of the only things I was going to say is I'm a bit of an old boy at heart. And so I love soul music. And so I have a playlist on my Spotify with songs like you say, like Michael Jackson, Eminem and 50 Cent being put into a 1950s soul soundtrack. And I'll send you the playlist after, because some of the tunes are
I'd love to.
So yeah, I'll send you those later because they're fantastic. And then what's your view on the current state of the crypto market? Because I'm actually getting to a point now where we're coming to a few levels that I've been looking at for a while and kind of didn't think we'd see this quickly. And so I'm tempted to start, specifically Bitcoin. With altcoins, I'm less inclined to just jump in. I like to see a minus 20 or 30% capitulation day. But I do think that Bitcoin's coming down to an area that is kind of interesting.
I think, like even with the trading itself, you need to understand your conviction. If your conviction is just based on opportunistic impulses, they will not serve you well when you are underwater. And I've seen it. I've known people that bought Solana at $20 in 2021 and rode it all the way up to over $100 and then back down to like $6 or something and then sold it. For it to go back up to almost 200 again. Okay, because they had no conviction or a real reason for why they're buying what they're buying. So first of all, and we still don't know exactly how bad that flush out in October was in terms of market makers really losing their last shirt. And it looks like it's worse than what people like to admit. So that's why I think a lot of markets probably have not seen their bottom, and it will temporarily pull Bitcoin more down. But, and this is the most important part, did anything of the fundamentals about Bitcoin that actually allowed it to go 100K and more change? Because to me, the simple answer is absolutely not. And in that regard, volatility is a gift. Every few years, it round trips in a way that if you manage to build conviction and education in that cycle, you get your opportunity to get back in at levels that you never thought you can. And even if you bought it at 100 or more, if you dollar cost average, and then actually keep your powder dry that you can dollar cost average stronger now, for example, than, for example, in the last 6 months. And you have the conviction to say, like, Bitcoin to me is a replacement of my retirement, is a replacement of buying real estate, is a replacement of even buying stocks potentially. Then I don't trade leverage. I stay far away from anything derivative. I buy the spot. I self-custody it, even, in my opinion. Again, people could argue, no, you should buy the ETF, then you don't need to worry about losing it and stuff like that. There's a whole different conversation. I personally think one of the most important attributes of Bitcoins is that something that you can actually own yourself. And if you don't, that's a part of conviction and education that you need to have. If you don't have these things and you don't understand that we're dealing with the strongest network the world has seen, with the extremely widely distributed network, whether they come now with the whole GE stories, like JE, what I don't want to say you guys' name here.
Don't get us cancelled.
the development of early stages. How does that matter today any longer? With that amount of distribution, with that size of a network, with nation states, sovereign funds, with ETFs, and if you have more risk appetite and you went on the whole MicroStrategy round trip, even that, I think, as the market recovers, and I think it's inevitable for Bitcoin long term to recover. Maybe I'm wrong, but this is my personal conviction here. The treasury companies, some of them, not all of them, obviously, have a chance of recovery as well. And I think even at the MNAV of 1, if Bitcoin goes to 500,000, 1 mil, the amount of Bitcoins that Strategy has acquired that really hurt their common stockholders will have that exponential growth on the tail end of it. And if you believe in that, you will happily buy Strategy and keep holding it. But it also comes, and this is what I mean earlier also with when you choose the asset that you trade. Strategy comes with more cross currents. It has now debt obligations. It has payments to make. It has also, it needs to keep capital reserves now, even in dollars, so that it can pay its dividends. For it also to qualify from S&P 500 and other standpoints, so to be not kicked out of these indices and stuff like that. So they have like more dimensions to the whole Bitcoin play going on there, which also adds more volatility. But I believe there's a good chance for that to actually go back up. But again, if you don't hold real spot Bitcoin, this is the only and the first thing you should actually learn about to a degree where you absolutely know to say, yes, I follow that reasoning and I believe it myself, or I don't. And only then you should decide whether you want to venture across the risk curve even higher, like with Strategy or things like that, or in just stay plain vanilla with an ETF, for example, or even the actual spot thing. So, and then, okay, if you go from that, like if you look at crypto itself, even here, all the smaller altcoins, those are like penny stocks. Those are like, they have no proven business concepts. Like most of them are like, it's like some kids pressing buttons, creating them, having fun, all good, fine. When the liquidity was more plenty in the market, there was a place for that as well. Nonetheless, like, okay, the only things I would ever look at would be layer ones. And even on layer ones, you can see like, okay, actually you have Ethereum and you have Solana. And even Solana is already because why is it working so badly in comparison to Ethereum that's slower, that's a lot more expensive, that has from a technology standpoint doesn't stand a chance to Solana. But it's because we hear like Larry Fink, I believe it was, saying like he wants to tokenize basically everything, stocks, real estate, whatever. And he said he wants to tokenize on one blockchain. And so far, the blockchain of choice for BlackRock has been Ethereum, not Solana. So you could argue all day long that Solana is the much better, efficient, faster type of blockchain, and that's technically true. But whether it's going to win or not, and this is the whole point that I'm trying to make, is that you seem at least old enough to know that MySpace existed at some point. Yeah. So
I was a MySpace boy.
So who in his right mind would have assumed that it's even possible to replace MySpace at the time? You know what I mean? And this is sort of the thing in these technologies that you really don't know. And now this is the argument also actually for Bitcoin, because I have this conversation time and time again where people say like, but what about a better Bitcoin comes across? And this is the point where I'm saying the probability for that is extremely, extremely low. For it's decentralized, it came all this way already, nobody owns it. All of these, like, it has this immaculate conception, and so it's, and even if there's intelligence involved of the creation of it. And I personally think there is an element that could point to that direction. It doesn't matter any longer. For the state and of development or stage of development has gotten by itself, okay? And proof of work has become now a currency of energy. So a proof of anything that's proof of stake, it's a currency of clicking a button, which is inflationary or just fiat in a different dress, you know, in comparison to me at least. You know, maybe I'm wrong. Again, like I'm speaking my personal convictions. I'm not talking absolute truths here. because it's very difficult to do that in that regard. But I think, especially now where we see that the bottleneck to AI technology development is, it's not even chip production, it's energy. Okay. And here we have a currency that's based or capital or whatever you want to call Bitcoin exactly, that's based on energy. When people ask me, well, what is it backed by? It's backed by nothing. Well, that's not particularly true. It's backed by a specific amount of energy that needed to be spent for it to be created in the first place. And this is why it has value. That's why it has more value than your dollar and your euros and any of these things. Again, you cannot convince someone by preaching to them. People have to find their own epiphany in that on their own, or decide for them that all of that is nonsense, which I respect. If you spend time educating yourself about it and you say like, nah, man, this thing's just gonna fail hard, fine. Because again, I don't know if I'm right, but what I know from everything I have learned and educated myself and keep challenging my education over years and years and years and years and years and years and years, I'm very happy to continue to accumulate spot.
Yeah. And also I think thinking it's going to fail, whilst it's a different opinion to the opinion that you and I hold, it's still a conviction in and of itself. Markets are a two-way dynamic where one person generally is right, one person is generally wrong, the short term at least. And so thinking it's going to fail is still a conviction, and you kind of need those people for at least you to win short term and perhaps long term as well. There's one question I wanted to ask you on crypto specifically, and it's a little bit more of a fun question. And it is because you mentioned strategy. Michael Saylor, do you think he's a genius or do you think he's a lunatic?
Well, first of all,
in between.
It's a very small degree between the two. I personally lean towards genius more than lunatic. Out of respect for his relentless effort. The amount of time this man has spent to articulate concepts and to preach them to the world is staggering. And up until only recently, there was one podcast with one Bitcoin guy that was really very, very negatively talking about strategy. He's never lost his temper. He's never been not patient. He's never been, of course you could argue, well, he's doing that because he's pumping his own back. He's just interested in the money. This man has been beyond the need of money a long time ago, okay? And so I respect him for putting in that much effort, actually being so courageous and bold, try to reform a whole credit system. And of course, he's being slapped around now where the market is down to some degree, and not even 20 months ago, he was on the top of the world. But if you see him then and if you see him now, I think he's always been very humble, very respectful, very much committed to his craft. And I have tremendous respect for that.
Yeah, I agree with pretty much the whole sentiment there. The only thing that I worry about, which I'd love to hear your thoughts on it, is he. And again, this is just my opinion. I feel like he may have backed himself into a corner, and who knows how bad that will get. So what I mean by that is, you've basically just explained it yourself. Saylor has been the biggest Bitcoin bull there has ever been. You know, he has been the biggest proponent ever. His whole business and ecosystem with strategy, is pretty much derived by Bitcoin. We see that between the correlation between the stock price and Bitcoin price as well. And there's so much debt within his company and shareholders that my concern is if for any reason Saylor ever or strategy ever come out and say we're offloading X amount of Bitcoin, what effect that has on the market. Because he at that point you would go, like, let's say for example we get to 200k and there's for whatever reason a large exodus of shareholders from strategy. He has to pay them off, but he has to pay off his debt, and I'm sure he's probably thought of this somehow, and I'm just not aware of the fail safes he has in place. But if they were to offload a large amount of Bitcoin, that sends out a completely different message for the first time in history. And we know these days with markets, specifically stocks and crypto, somebody's word can dictate these markets astronomically. Saylor, Elon, Trump, all of these different people. So I don't know if you know something that I don't in regards to that, but that's my only concern about the whole strategy Bitcoin relationship.
Fair enough. I totally hear a reasonable doubt, let's just say. So the way I see it is that he's created a bunch of preferreds, and they are what he's doing it, and he compares it to like an oil distillery. You pump crude oil out of the ground, and you create all these different petrochemical grade type of products out of it. And that's basically what he did. The crude oil is Bitcoin, and then he created Stride, and now Stretch in the latest iteration. What these preferreds do is they strip away certain volatility, but also give a lot less upside in return. And I think especially Stretch, STRC, it's paying 11% per year at the moment, and paid monthly in dividends, and it's trading at around $100 par. And it's a little bit too early to say it's a proven concept, but now every X dividend date that has happened, the price of that instrument went down less and recovered again very quickly. As soon as it trades above 100, he sells it to buy Bitcoin with it. So, and if you look at the size of a potential market, the money market is trillions large. And the most important part of why I have conviction in Saylor's strategy is that his leverage across of how many Bitcoins he has and how much obligations he has and instruments he issued is very low. It's really low. That's what people still confuse. He has enough Bitcoin to pay his obligations for a very long time. And he continues to dilute. That's the only thing that you could say you could have hard feelings about, is that he continues to sell ATM almost every week. So basically, he sells his own common stock. He creates new shares and he dumps them on the market. But the reason he does that is, like, number one, he continues to be able to do it. He generates liquidity through that, and that means there is a demand for it. So he's just satisfying the demand, and at the same time, he even took a few $1 billion now that he kept to pay out the dividends of his preferreds. So essentially, even if Bitcoin went down and stayed down for 2 years, he has enough dollar reserves to pay his obligation. And any debt obligations he has, he doesn't need to pay them back. It's not a loan where he owns someone money back. You know, the way it's structured is really, really smart and intricate. So again, I would recommend everyone to spend time on education. You know, it's very easy to say, like, this guy's lunatic, this guy's this guy's that. But if you really dig, the devil is in the details. Okay, and that's why I feel very much connected to Saylor, because sure, he's in a more field that is still forming a little bit. For example, like some months ago, he said, like, okay, we will not dilute our shareholders under a certain MNAV, meaning the value of the company versus the Bitcoin it holds, okay, the value of the stock. But he went back on that and continued to sell the stock. But again, because I think he was able to, he was still, it's the one thing that a lot of people now not anymore, because now it's trading at a little bit above 1.09, I think it was yesterday. But when it was trading at 1.5, 1.6, it means like you could buy 1.60 amounts of Bitcoins for every dollar he sold. So it's accretive. It's not dilutive. From a Bitcoin perspective, from a fiat perspective, it is dilutive because the price of the stock went further down. But if you believe in a long-term story of Bitcoin continuing to go up, and then you look at, even if the MNAV of that company stayed at 1, meaning the value of the shares is the same as the value of the Bitcoin, as the Bitcoin goes up, you will still make huge returns on these. And each of these preferreds are really a whole universe for them. He actually said that he created them in conversations with AI. That comes on top. Like, it's also maybe something I find particularly cool. They created financial instruments that never existed before. And he needed to convince regulators, banks, custodians, all of these guys, this stuff is listed, okay? It's not like some
back-end stuff.
Exactly. So all the respect to this man and his courage, in my opinion, to his conviction. And his conviction is not just some ideology-driven religious crusade, but actually really more based on engineering. And that's why me, in a much smaller frame, obviously, but I feel I do the same in my trading strategy, just in a very different degree, obviously.
No, what a fantastic answer. I mean, like I say, it was a concern of mine because and I'll be the first to admit, like, I don't understand and have never really done any study into his structure from a fund perspective. I listen to memes of him. I've watched some interviews of him. The main thing that you take, I think, if you sit down and listen to Saylor, is he definitely 110% knows and understands what he's talking about when it comes to Bitcoin, but more so, like you say, has full conviction and belief, and he will fight tooth and nail to the death. So yeah, what a response. Thank you for that. The last question, because we're going to have to wrap up in a moment. The last question I have for you, and I want this to be kind of raw and honest, is what is one hard truth that you would tell yourself when you was grinding on the corporate ladder, before you had your son and before you stepped away from professional trading, when you was working towards these awards that you won? What's the one hard truth you would tell yourself to save yourself years and years of struggle?
Basically, look, I think there's a narcissist in all of us. And we want to be cool, we want to be validated, we want to be like special. And I think the sooner you understand you are already, you don't need to prove it by anything out of the ordinary, but actually you prove it with real reliability, the sooner you will actually be able to build something of substance.
Fantastic. Short, sweet, and great. I appreciate that, dude. Well, it's been an absolute pleasure to talk to you again, Alex. I'm sure we'll jump on and do another session soon. I know we said that last time, but I'm hopefully going to make the trip over to Cyprus soon, and you and I can sit down and map out some content and stuff. I know we've spoke about doing that in the past, and from our conversations, we end up rambling on about subtopics for hours on end. So I'd love to kind of get that and get it out there so that people can come and listen to it.
Very cool. Again, thanks for having me. I'd be thrilled to do something together here in person even more.
Awesome. Sounds good. Appreciate your time, Alex. Thank you once again.
Thank you.